Hey guys, I just want to do a quick video on my option strategy for a bearish market. We're going to look at ticker symbol SPY, which is the derivative of the S&P 500. A lot of people trade options off of SPY, or they'll buy SPY because it's a much cheaper price point for someone to get into trading an index than actually the major index. One thing that's I want you to note is during a market dip or any volatility, the volatility index, which is the VIX, goes up, okay? All of the option premiums have what's called implied volatility in them. And that implied volatility is basically, it is their, the market makers are now saying, hey, we're gonna inject implied volatility into the options. It's gonna increase the premiums of the options because there's more risk of losing shares or getting shares assigned, and it's the way that the market makers hedge themselves against the options that they wrote, whether they're leveraged, and which, by the way, the market makers write naked calls, naked puts. It means that they don't own shares. They have to hedge for that. But it's more and more likely that they will end up owning shares at a certain price point, so they will jack up those option premiums, which for me as an options writer is great because I'm going to be selling puts. Okay, and this is a cash. Okay. Typically selling puts, and the definition of selling a put means that I am obligating myself to buy shares at a particular strike price or stock price on a certain day. Okay? And I have to put up the cash to buy those shares. And typically what you want to do is, if you're in a bullish market, you sell puts, and you might do what's called a bull put spread, where you sell a put and you buy a put, and then as the stock price rises, the put that you sold devalues. Okay, buying a put it means that you're bearish on the stock, which means that you can sell shares at a higher price than the stock is, and then you can pocket the difference. Okay, if you're not too familiar with selling puts, selling calls, buying calls, I encourage you, there's a lot of good content on that. I'm not going to go into the actual mechanics of that, but I'm going to show you about why I'm going to be selling puts in a down market. So as the stock price drops, let's say this is a Monday, okay? Yeah, we'll do Monday over here. And let's say SP, we'll just do XYZ stock is at $10, and it has dipped down to $7 on Thursday. Okay. What I can do is I have the ability, if I have, and let's say $6 would be an out of the money. Okay. So based off of we'll do $8 here. And I do apologize, writing options can be a little bit confusing at first, but it's a very good strategy to begin to want to understand, to want to dig into, because it gives you a lot of leverage and a lot of options, quote unquote, when the market is volatile, when you're unsure of movements, or when you just want to be able to leverage your cash. Okay, so it's Thursday. The stock is at $7. It has fallen from $10, okay? And I think that it might have reached an area of support. Okay? I don't want to sell puts if I think the stock's just going to keep tanking. But I'm also wanting to sell them a day or two before expiration because there's less time and it's less likely that I will be assigned shares. Okay, so because the stock has fallen down, the put premiums will be elevated, which means they will be much higher, and the out of money options that I can sell. Okay, so if the stock's at 7, a $6 put or a $5 put would be considered out of the money. Okay, an $8 put would be what's called in the money. Okay, and it's important to understand, if you need to go look those up, in the money, at the money, and out of the money, I would encourage you to go check on that. So I'm going to sell a $6 or $5 put on a Thursday, the day before expiration, hopefully, and I'm betting the stock won't fall considerably before Friday. Okay, this is already the rest of the week. It's been through a bloody week. It's been chopped up pretty good, and I think it's at the bottom for this week, and that it won't go down to $6 or $5 by Friday. Okay, because what I want this to do is these $6 and $5 puts that I sold, I want them to, my goal is for them to expire okay, which means that the options that I wrote, and that's true for any options that are calls or puts, if they expire what's called out of the money on the day of expiration, they expire worthless. And I want the guy that bought that $5 or $6 call that's betting on the stock to go down, I sold the call, I want that call to expire worthless, which means that I will, for a $5 stock, or actually, no, the stock was at 7, I would have to put up $700 cash, plus I received the put premium, which could be $50 or $80. So I would end up with $780 or $750, and even unless I got assigned, and that the goal is to leverage Now I'll write this out. Okay, I don't want to own anything, but I want to leverage cash, okay, and earn and I want to earn interest, which is I want to build up my cash by selling these puts during this down market, because the puts are inflated. I'm just going to sell them close to expiration, and I'm going to sell out of the money. And I'm going to, unless I want to own the shares. You don't want to do this in a stock that you don't want to own. Okay, if you're like any of the big tech stocks and you think they're going to rebound and you want to own shares in them, but you want a discounted price or get paid to own that stock, you can sell puts. Okay. I'm not going into all the mechanics of selling puts and all the gotchas. There are things to think about that I'm not going in here, that I encourage you to study. But I am trying to show you the majority of the reasoning behind why I'm going to be employing this strategy. I also want to be able to snowball my cash, so that way if the market totally bottoms out and I see a good buying opportunity to actually own the stock, I can do that. But I don't have to, just ride SPY all the way down to $100 or something ridiculous and watch my portfolio get tanked out, And there's other option strategies that you can do if you think the market's gonna, fall out. You can employ an option spread using covered calls if you do own shares, and I have some other videos on that. I've got a good buddy right now that he has a bunch of different stocks. They're all down right now. His crypto's down, and a lot of people think that the market might continue falling. And so there's a couple of different options that you have when writing options on how you can protect yourself by either you pull out and you go all cash, or you write covered calls and you can buy some puts. So if the market tanks, you can still have a decently green portfolio, or hedge your portfolio using those puts and selling those calls. If you guys have any questions or comments, or you want me to go into more detail on this, I'll be more than happy to. Thank you for your time.